The global financial markets were wrapped in a deceptive silence during the final days of December 2025. While traders in New York and London were distracted by the holiday lull and the closing of yearly books, a seismic shift was occurring on the other side of the planet. Beijing does not follow the Western liturgical calendar, and their most strategic moves are often executed when the rest of the world is looking the other way. On a quiet weekend, the Chinese Ministry of Commerce released a document that effectively changed the rules of the global silver market forever. Known as Announcement Number 68 of 2025, this policy framework targets the export of strategic metals for the two-year period of 2026 and 2027. Among the list of controlled substances was silver, a metal that has served as a cornerstone of human wealth for over 5,000 years. As the news filtered through the algorithmic trading desks on Sunday evening, the spot price of silver did not just move, it exploded. We watched in real time as the numbers on the screen surged toward $79.30 per ounce. This is not just a high for the decade, it is a level that challenges every historical precedent in the era of fiat currency. We are entering uncharted territory where the old maps of technical analysis and resistance levels are being burned to ashes. For years, the mainstream financial media told you that silver was a relic of the past. They told you it was a dead asset, a frustrated metal that would never break its $30 ceiling. They laughed at the stackers and called the industrial silver deficit a myth. But look at the market today. The talk of a generational bubble is everywhere on news networks like The Guardian and CNBC, yet they fail to mention the primary driver. This is not a bubble born of speculation. This is a cold, calculated strike by the world's largest industrial powerhouse. China is the third largest producer of silver on Earth, but more importantly, they are the world's largest consumer and refiner. By issuing Document 68, Beijing has declared that their domestic industrial survival comes before the liquidity of the Western paper markets. They are no longer willing to export their strategic physical reserves to settle futures contracts on the COMEX or the London Bullion Market Association. The implications are staggering. We are witnessing the birth of a physical silver squeeze that makes the events of 2021 look like a minor tremor. This is the moment where the paper promises of the banking system meet the hard reality of a supply chain that has finally run dry. In this video, we will dissect exactly how Beijing lit the fuse on this powder keg and why the next stop for silver is not $80, but a triple-digit reality that will reshape the global economy. To the untrained eye, Document Number 68, published by the Chinese Ministry of Commerce in late 2025, might look like a standard administrative update. But in the world of global macroeconomics, it is a surgical strike. This document marks the formal reintroduction of a strict quota and licensing system for silver exports, a mechanism that had been largely dormant or loosely managed for years. Beijing is no longer asking for cooperation. They are demanding total state control over every ounce of silver that attempts to cross their borders. The specifics of this policy are designed to filter the market, leaving only the largest, state-aligned entities with the right to export. For any newly applying production enterprise, the threshold has been set at a minimum annual output of 80 metric tons. In the western regions of China, where mining is more challenging, this threshold is lowered to 40 tons. But the message remains the same. Small and medium-sized producers are effectively banned from the international market. This consolidation ensures that the Chinese government has a single, direct lever to pull when they decide to tighten the noose on global supply. Furthermore, the eligibility criteria are not just about production volume. Exporters must prove a consistent track record from 2022 through 2024. They must hold specific international certifications and maintain a clean legal and tax record. By January 1st, 2026, any company that fails to meet these rigorous standards will be cut off. For the global market, which relies on China for 60 to 70% of its refined silver supply, this is a catastrophic contraction. Why now? Why would Beijing choose this exact moment to choke the export market? The answer lies in the phrase state trading. In the Chinese context, silver has been reclassified from a mere commodity to a strategic national asset, akin to rare earth elements. The Chinese leadership has recognized that the silver market has been in a structural deficit for 5 consecutive years. By late 2025, the global gap between demand and supply has widened to nearly 250 million ounces. Beijing knows that the West is desperate for physical metal to fuel its green energy transition and advanced military technologies. By controlling the flow through Document Number 68, they have created a strategic choke point. They are essentially telling the Western banking system that the days of using Chinese silver to suppress prices on the COMEX are over. If the London or New York vaults run dry, they will no longer be able to count on a surge of Chinese exports to bail them out. The dragon has closed its hoard. and the rest of the world is about to find out exactly what happens when the physical supply of money itself becomes a tool of geopolitical warfare. The move by Beijing to restrict silver exports is not merely a financial maneuver. It is a calculated effort to safeguard the lifeblood of their industrial future. In the modern world, silver is no longer just a metal for coins and jewelry. It is a high-performance industrial metal with the highest electrical and thermal conductivity of any element. Without silver, the entire global energy transition would come to a grinding halt. China, having secured its dominance in solar technology and electric vehicle production, now intends to secure the raw materials necessary to maintain that lead. Consider the solar energy sector. As of early 2025, China manufactures over 80% of the world's solar panels. Each photovoltaic cell requires silver paste to conduct electricity from the silicon wafer to the circuit. While researchers have tried to reduce the silver content per panel, the sheer scale of global installations has overwhelmed those efforts. In 2025 alone, the solar industry is projected to consume more than 190 million ounces of silver. By 2030, that number could exceed 300 million. By restricting exports, Beijing is ensuring that their domestic manufacturers, such as those producing high-efficiency TOPCon and heterojunction cells, have priority access to physical supply, while their Western competitors are left to fight over the scraps in the paper market. The electric vehicle revolution adds another layer of intense demand. A typical internal combustion engine vehicle uses between 15 and 28 grams of silver. However, a battery electric vehicle requires between 25 and 50 grams, nearly double the amount. Silver is found in every critical system, from battery management and power inverters to the extensive charging infrastructure required to power them. As China continues to lead the world in electric vehicle adoption, their domestic need for silver has reached a tipping point. They have realized that exporting silver to the West at $30 or $40 an ounce while their own industries face shortages is a strategic error they are no longer willing to make. Furthermore, we must look at the emerging field of artificial intelligence and semiconductor manufacturing. Silver is increasingly used in advanced chip packaging and high-performance connectors for data centers. The total global information technology power capacity has increased by over 50 times since the year 2000, reaching nearly 50 gigawatts in 2025. This massive expansion of digital infrastructure is built on a foundation of silver. By weaponizing silver through export controls, China is effectively putting a tax on the Western tech sector. They are forcing companies like Tesla, Apple, and various semiconductor giants to face a choice. Either pay exorbitant premiums for the limited physical silver available in the West, or move their manufacturing closer to the source of the metal inside China. This is not just about price. It is about resource sovereignty. Beijing has recognized that in the 21st century, the nation that controls the physical supply of critical conductive metals will control the pace of technological progress itself. For decades, the price of silver has been dictated by the paper markets of London and New York. On the COMEX and the London Bullion Market Association, billions of ounces are traded every day in the form of futures contracts, options, and exchange-traded funds. However, there is a dark secret that the banking establishment does not want you to realize. The amount of paper silver traded often exceeds the actual physical silver in existence by a ratio of more than 100 to 1. We are now approaching the moment where the owners of those paper promises are all going to show up at the vault at the same time, only to find the shelves are empty. As of the end of November 2025, the official data from the London vaults showed approximately 27,087 metric tons of silver. While that sounds like a massive mountain of metal, we must look closer at who actually owns it. Out of that total, more than 60% is held by a single entity, the iShares Silver Trust, commonly known as SLV. When you subtract the silver held by other major exchange-traded funds and the allocated accounts of ultra-high net worth individuals, the amount of float or silver actually available for industrial delivery is dangerously low. The divergence is becoming undeniable in the bid-ask spreads and the physical premiums. While the spot price on your screen might say $79.30, try going to a major dealer to buy a 1,000-ounce bar. You will quickly find that the real price, the all-in cost, to get metal in your hands is significantly higher. This is because the physical market is beginning to decouple from the paper manipulation. The banks can sell as many paper contracts as they want to suppress the price, but they cannot print physical silver atoms into existence. The situation at the CME Group is even more critical. We are seeing a record number of long position holders who are refusing to roll over their contracts into the next month. Instead, they are standing for delivery. They want the metal. They want the bars. They want the security of an asset with no counterparty risk. When China's Ministry of Commerce restricts exports, they are removing one of the primary emergency valves that the Western banks use to replenish these vaults. Historically, When the Western markets faced a physical squeeze, metal would flow from the east to the west to capture the premium. But with Document 68, Beijing has welded that valve shut. If a major bank like JP Morgan or HSBC faces a massive delivery demand and cannot find the metal in London or Singapore, they will be forced to bid the price up to levels that would have seemed impossible just a year ago. We are moving from a world of price discovery to a world of availability discovery. In such a market, the paper price becomes an irrelevant abstraction, while the physical metal becomes priceless. This is how the system breaks, not with a whimper, but with a massive, violent re-rating of the only thing that actually exists, the physical bar. When the wealthiest man on earth speaks about raw materials, the world listens. Elon Musk, a man whose industrial empire spans from electric vehicles at Tesla to orbital rockets at SpaceX, has recently broken his silence on the silver market. In a series of public statements on social media, Musk described the current supply situation as not good. For a CEO who has historically focused on lithium and nickel, this pivot to silver is a massive red flag for the global technology sector. The Musk empire runs on silver. Every Tesla Model 3 or Model Y rolling off the assembly line is packed with advanced electronics that rely on silver's superior conductivity. From the autonomous driving sensors to the battery management systems, silver is the invisible glue holding the hardware together. SpaceX requires even higher grades of silver for the specialized circuitry and solar arrays used in the Starlink satellite constellation. When Musk expresses concern about supply, he is not speculating as a trader. He is speaking as a desperate customer who sees a looming wall of scarcity. The panic is not limited to Tesla. Throughout Silicon Valley and the industrial hubs of Europe, supply chain managers are entering a state of emergency. They are looking at the announcement from the Chinese Ministry of Commerce and realizing that their primary source of refined silver is being throttled. For years, these companies operated on a just-in-time inventory model, assuming that silver would always be available at the click of a button. That era of complacency is over. We are now seeing the beginning of panic hoarding at the institutional level. Reports are emerging of major technology firms bypassing the traditional bullion banks and attempting to secure long-term supply contracts directly with mining companies in Mexico and Peru. They are terrified that if they do not lock in physical delivery now, they will be forced to shut down production lines in 2026. This is exactly what happened during the semiconductor shortage of 2021, but with one critical difference. You can build more semiconductor factories, but you cannot build more silver mines. The industrial panic is the ultimate catalyst for the silver squeeze. Unlike retail investors who might sell if the price drops $5, industrial consumers like Apple, Samsung, and Tesla are price insensitive. They must have the metal at any cost because the cost of silver in a smartphone or a car is a tiny fraction of the total price, but the absence of that silver makes the entire product impossible to build. As these giants begin to compete with each other and with the banking system for a shrinking pool of physical bars, the upward pressure on price will become exponential. The tech sector is finally waking up to the reality that they have built a digital world on a foundation of a physical metal that is rapidly disappearing into the vaults of the East. The word bubble is the favorite weapon of the financial establishment. Whenever an asset they do not control begins to rise rapidly, they use this term to trigger fear and force retail investors to sell. We heard it in 1973 during the oil crisis, and we heard it again in 2021 with palladium. Today, as silver sits at $79.30, the mainstream media is screaming that a generational bubble is about to burst. But history tells a very different story. To understand where we are going, we must look at the 1973 oil embargo. Before that crisis, oil was priced at around $3 per barrel. Within a few months, it tripled to $12. The media called it a bubble. They said the price was unsustainable, but oil never went back to $3. Why? Because the fundamental supply-demand reality had changed. The world had realized that cheap energy was over. We are currently witnessing the same phenomenon in the silver market. This is not a speculative spike, it is a structural repricing of a metal that has been undervalued for 50 years. Image comparing silver price 1,980 versus 2025, inflation adjusted. Let's look at the numbers. In 1980, silver reached a nominal peak of $49.45 per ounce. If we adjust that figure for the real inflation of the last 4 decades, silver would need to be priced at over $170 today just to match that previous high. At $79, silver is still effectively 50% cheaper than it was 45 years ago, even as its industrial necessity has increased by 10,000%. This is the opposite of a bubble. This is a market that is finally catching up to decades of currency debasement. Another powerful precedent is the palladium squeeze of 2018. Palladium was once a forgotten metal, trading at lower prices than platinum. But when emission standards changed and the supply from Russia became uncertain, the metal underwent a violent re-rating, surging from $500 to nearly $3,000. Like silver today, palladium was an industrial necessity with no easy substitute. Once the unobtainable phase begins, the price is no longer driven by investors. It is driven by the physical reality that the material simply isn't there. The current silver rally is backed by 5 consecutive years of structural deficits. According to the Silver Institute, the world has consumed 820 million more ounces of silver than it has mined since 2021. That is nearly an entire year of global production that has been pulled from existing inventories. When inventories reach zero, the price doesn't just rise, it gaps. We are not in a bubble created by dumb money on Reddit. We are in a repricing event driven by the laws of physics and the exhaustion of 5,000 years of accumulated silver stocks. Beijing knows this. Elon Musk knows this. And soon, the paper shorts on the COMEX will be forced to acknowledge it too. When we look at the technical charts for silver at the end of 2025, we are seeing patterns that have not existed in the history of modern commodity trading. The most striking data point is the Relative Strength Index, or RSI. In a standard market, an RSI above 70 is considered overbought, signaling a time to sell. However, silver is currently trading with an RSI in the high 80s. In any other asset, this would indicate an immediate crash. But in a supply-driven squeeze, a high RSI simply confirms that the momentum has decoupled from the mean. The market is no longer respecting traditional resistance levels. For years, the psychological barrier was $30, then $50. Now, as we hover near $79.30, the technical analysts are scrambling. Daily Forex and other major analytical firms have described this price action as meteoric. The reason is simple. When a market enters a short squeeze combined with a physical stockout, there is no overhead resistance. There are no sellers left at these prices except for the bullion banks who are desperately trying to defend their remaining positions. We must also discuss the phenomenon of gap risk. Because silver trades 23 hours a day, but the major equity markets like the New York Stock Exchange only open for limited hours, we are seeing massive price gaps. When the Chinese Ministry of Commerce released Document 68 over the weekend, the markets were closed. When the CME Globex electronic trading resumes on Sunday evening, the price will not start where it left off on Friday. It will gap up. Imagine waking up on Monday morning to find that silver has jumped from $79 to $84 before a single share of the silver mining stocks or the SLV ETF has even traded. This creates a panic loop. The short sellers, who were already underwater, face immediate margin calls at the opening bell. They are forced to buy back their positions at any price to avoid total liquidation, which in turn pushes the price even higher. This is the gamma flip that leads to vertical price moves. The technical targets have now shifted. With $79 acting as the new floor, the next major objective is the $81 to $82 range. But once $85 is breached, there is a technical vacuum all the way to $100. We are moving into a phase where silver is behaving more like a high volatility technology stock or a cryptocurrency than a boring precious metal. This is the definition of uncharted territory. The old rules of buying the dip may not apply because, in a true supply crisis, the dips are shallow and the gaps are enormous. If you are waiting for a perfect technical entry, you may find yourself watching the price move to triple digits from the sidelines. The silver market is no longer just a playground for traders. It has become a primary battlefield in the escalating trade war between Washington and Beijing. In November 2025, the United States Department of the Interior made a historic move by officially adding silver to the final 2025 list of critical minerals. This was not a mere bureaucratic update. By classifying silver alongside lithium and rare earth elements, the U.S. government has acknowledged that silver is a matter of national security, essential to defense systems, advanced semiconductors, and the entire energy grid. This designation has triggered a massive shift in U.S. trade policy. Under the current administration, silver has been pulled into the crosshairs of a Section 232 investigation. For those unfamiliar with the term, Section 232 of the Trade Expansion Act of 1962 allows the president to impose tariffs or quotas on imports that are deemed a threat to national security. With silver now on this list, the possibility of a 100% tariff on Chinese silver imports is no longer a fringe theory. It is a live policy option being discussed in Washington. The geopolitical tension is being mirrored in Mexico, the world's largest silver producer. In June 2025, the Mexican government under President Claudia Sheinbaum announced a complete moratorium on new mining concessions. While existing mines like those operated by First Majestic and Pan American Silver continue to produce, the lack of new permits means that the long-term pipeline for silver is effectively frozen. Mexico is shifting toward a model of resource sovereignty, demanding a higher share of profits and stricter environmental compliance. For Western industrial consumers, this means the safe supply from our southern neighbor is becoming more expensive and less certain. Bakin is fully aware of these vulnerabilities. By implementing their own export controls via Document 68, they are front-running the American tariff strategy. They are essentially saying, you cannot tax what we refuse to sell you. This is a classic tit-for-tat escalation. China controls nearly 70% of the world's silver refining capacity. Even if silver is mined in Peru or Australia, much of it still flows through Chinese refiners before it reaches the global market. We are moving toward a bifurcated market. On one side, we have the Eastern Bloc, led by China and Russia, which is hoarding physical metal to back their industrial dominance and potential new currency systems. On the other side, we have the Western Bloc, which is scrambling to secure alternative supply chains through agreements with allies like Australia and Canada. But as the Section 232 investigation proceeds, the cost of sourcing silver for American solar manufacturers and defense contractors will skyrocket. In a trade war where silver is a primary munition, the side with the most physical metal in their vaults holds the ultimate high ground. We are now entering the early stages of what historians will eventually call the great wealth transfer of the 2020s. For decades, the majority of global wealth has been stored in counterparty assets, stocks, bonds, and bank deposits that are essentially promises to pay. But as the structural deficit in silver collides with a global loss of faith in fiat currencies, capital is beginning to move toward hard assets that cannot be printed, diluted, or defaulted upon. In this transition, silver is not just a commodity. It is the ultimate vehicle for wealth preservation and growth. To understand the magnitude of this opportunity, we must look at the gold to silver ratio. For most of human history, from the Roman Empire to the 19th century, this ratio was fixed at roughly 15-1 or 16-1. This reflected the natural occurrence of these metals in the Earth's crust. However, in late 2025, even with silver at $79.30, the ratio still sits near 60-1, as gold has also surged toward $4,500 per ounce. Image showing the gold to silver ratio chart from 1900 to 2025. This disparity is a massive mathematical anomaly. If the ratio were to simply return to its long-term historical average of 40-1, silver would need to be priced at $112 today. If it reached the monetary ratio of 15-1, we would be looking at silver at $300 per ounce. What we are seeing in 2025 is the beginning of this mean reversion. As institutional money realizes that silver is outperforming gold, gaining over 150% this year compared to gold's 60%, the chase for the white metal will only intensify. The nature of this wealth transfer is deeply tied to the exit from the banking system. When you hold silver in physical form, you are removing your wealth from the digital ledgers of the financial establishment. You are moving from a system of debt to a system of equity. In 2025, as the United States face record government debt burdens and the Federal Reserve begins to ease interest rates despite persistent inflation, the real value of the dollar is evaporating. Silver, being a critical industrial necessity and a monetary safe haven, is capturing that lost value. The retail investor who holds physical silver is effectively front-running the largest corporations and central banks. While the banks are trapped in their paper short positions and the tech giants are panicking over supply chains, the individual stacker who bought at $30, $40, or $50 is now witnessing a life-changing appreciation in purchasing power. This is the vindication for everyone who was told they were foolish for holding a pet rock. As the paper market seizes up and the physical premiums continue to expand, the world is rediscovering a truth that has been forgotten for a century. Paper is a promise, but silver is payment. As we stand on the precipice of 2026, the silver market is no longer a place for the indecisive. The combination of Beijing's export chokehold, the expansion of the United States critical minerals list, and a fifth consecutive year of structural deficits has created a perfect storm. We are moving from a period of high prices into a period of total supply unavailability. If you intend to protect your wealth and capitalize on this repricing, you must have a clear, unemotional strategy. First, you must address the counterparty risk in your portfolio. While exchange-traded funds like SLV or silver mining stocks offer high liquidity and exposure to price movements, they are ultimately paper claims. In a true physical squeeze, where the London and New York vaults are drained, the gap between the paper price and the physical metal will widen into a chasm. Your primary objective should be the possession of physical silver bars and coins held outside of the banking system. When the system breaks, the only silver that matters is the silver you can touch. Second, you must prepare for extreme volatility. As silver approaches $80 and looks toward the $100 milestone, the banking establishment will attempt liquidity raids. They will use high-frequency trading algorithms to trigger massive sell-offs designed to shake out the weak hands and hit your stop-loss orders. Do not be fooled by a 5 or 10% drop in a single day. In a structural bull market, these are not signals to exit. They are gifts for those with cash on the sidelines. The fundamentals, China's restrictions, and the industrial AI boom do not change because of a daily chart correction. Third, monitor the lease rates and physical premiums more closely than the spot price. If you see that dealers are charging 20 or 30% over the spot price, or if delivery times for 1,000-ounce bars extend to months, you know the paper market is failing. This is your signal that the unobtainable phase has begun. At that point, the price becomes secondary to the fact of ownership. In conclusion, we are witnessing the end of an era, the era of cheap, abundant silver that fueled the first wave of the digital and green revolutions is over. Beijing has recognized this, and by implementing Document 68, they have claimed their stake in the future. The West is now scrambling to react. As an investor, you have a brief window of opportunity before the silver flood of paper assets turns into a physical drought. Silver at $79.30 is not the end of the rally. It is the beginning of the great revaluation. Whether it is $85, $100, or even $200 an ounce, the destination is clear because the math is undeniable. You are either holding the line with real, physical metal, or you are holding a promise that may never be kept. The choice is yours. The markets reopen tonight, the world is watching, and the silver is disappearing. I am Asian Guy, and I will see you in the next update as we track this historic squeeze to its conclusion.